Hi everyone. In today's video, we're intending to discuss ICAAP for NBFCs. We intend to discuss what is ICAAP and its relevance for NBFCs. As you might be aware, the SBR framework, that is scale-based regulatory framework introduced for NBFCs, have brought in the requirement for NBFCs to undertake ICAAP, that is middle layer and above entities, to undertake this particular analysis to determine whether the capital maintained by them is adequate or not. We should first start with understanding what is ICAAP. So when we talk about what is ICAAP, ICAAP is basically, as the name suggests, an internal process to determine whether the capital I've maintained is adequate or not. This brings us to the question, then what happens to the CRR requirement? Are they still there? Yes, they're still there. But how would ICAAP play with the CRR? We would discuss further into this video. To give you a broad overview, how ICAAP works is that first we analyze or we undertake the capital adequacy assessment. We assess that the capital that I'm providing is adequate or not. Now, how do we do this? That's a second step. We will come to it. Once I've done this assessment, I prepare a ICAAP document. This ICAAP document summarizes the methodologies and what are the final results. These results and methodologies are submitted to the board. Board reviews it. If it finds proper, it will approve it, and then I submit to the RBI. The intent of this is to assist RBI to undertake a better supervisory review of my entity. Hence, as this falls or assist in the supervisory review and evaluation process, this particular requirement of ICAAP falls under pillar 2 of the Basel framework. Now, why does the requirement for ICAAP arise? Why do I have to do an internal capital adequacy assessment when there is already a CRR requirement prescribed by RBI? So here we need to understand that every NBFC has operations that are distinct, that are different from other entities. Its risk faced are different. Its complexities of operations are different. Its operational methodologies are different. Hence, the amount of risk that it faces is also different. Hence, a single ratio or a single percentage of capital may not be sufficient for all the entities. Some entities might require more capital, some may require less capital. To address this particular issue, RBI came out with the ICAAP requirement. So here we bring in two concepts. One is regulatory capital, another is economic capital. Regulatory capital is what is regulator prescribes. So regulatory capital always acts as a minimum floor. However, under ICAAP, we target to determine that whether the economic capital, that is the capital that I'm actually maintaining, is sufficient or not. That being said, we move towards why the RBI came up with the requirement for ICAAP for NBFCs. As we are aware, this requirement was already in place for banks. Now, with banks already complying with it, what RBI realized is that the systemic importance of NBFCs is increasing. Under SBR framework also, what RBI has tried to do is bifurcate between NBFCs or classify NBFCs based on their scale and their systemic importance. Based on this, RBI said that there are some entities whose operations pose such systemic risk that they should comply with the regulations that are either similar to or near to banks. An extension to this was implementing ICAAP for middle layer NBFCs and above. To further add on the statement that I made that the systemic importance of NBFC is increasing, I have a chart over here. So what we observe over here in this red boxes, that HFCs and NBFCs are the largest payables to the financial sector. That is to say that the NBFCs and HFCs have borrowed a lot of funds from the financial sector, because majorly all the funding of NBFCs and HFCs come from banks. That most of them are aware. NBFCs are funded chiefly by banks. Now these banks borrow public's money. So in case NBFCs default, there is a huge risk on the public's money. So to help us avoid any defaults on the part of NBFCs, we need to maintain sufficient capital. How to ensure that the capital is sufficient? We do an internal assessment and determine that the capital is sufficient or not. If not, we raise further capital. Hence, this requirement was stretched to NBFCs as well. To go a little step backwards, as I mentioned, that this requirement comes from the SBR framework. So what all NBFCs are required to comply with it? As I said, all the NBFCs that are middle layer or above are required to comply with ICAAP. Now, who would fall under middle layer? The NBFCs with asset size more than 1,000 crore. All the HFCs would fall under middle layer, irrespective of the asset size. Then we have NBFCs with no customer access and public funds. So these NBFCs would not fall under middle layer, irrespective of the size. So all HFCs and NBFCs, except these three that I mentioned over here, NBFCs with no customer interface access to public funds, P2P account aggregators, NOFHC, and NBFCs with asset size up to 1,000 crores are not required to comply with the ICAAP requirement. Rest all NBFCs would be required to comply with this requirement. And HFCs are required to comply because irrespective of the asset size, they will fall under middle layer. Now, internal assessment of, now where do I get the guidance of ICAAP? So there is no specific circular for ICAAP for NBFCs. Rather, the SBR framework itself refers to Master Circular Basel III Capital Regulations dated July 1, 2015. This is a circular for banks. Now, this has been referred under SBR framework. So all the guidance on how the particular ICAAP for NBFCs would work out would come from this circular. Here, it should be important to consider that this particular circular was prescribed for banks. Hence, not all the requirements would be applicable for NBFCs. So we have to appropriately factor the circular to apply to NBFCs. So we have to read it in such a way that to the extent it's applicable to NBFCs, we apply to it. Accordingly, the framework for the NBFCs has to be decided. What will be the first steps to be done? So of course, the first step would be when I talk about setting up any framework, I would need a board approved policy. The board to set up a particular framework, it would have to first approve a policy. That policy would prescribe the broad framework, responsibility allocations, how the ICAAP process would work out. Once that policy is set up, then I undertake the assessment process. We will discuss in brief what the process is, what are the steps involved in it. Once that process is complete, I prepare an ICAAP document, get a board approval, and then submit it to RBI. That is a broad overview of how ICAAP would work. Now, once I submit this document to RBI, RBI would review my particular operations and may come up with some prescriptions for me. That being said, now we take a one step ahead on objectives of ICAAP. So when I say the ground objective is clear that I need to have a capital that's adequate. But why? Because I need to absorb losses. There can be multiple losses faced due to my operations. To absorb those, I require a capital. Now, say I face a credit risk of 10%, or my 10% of my loans default. Now, if this particular loss is carried to my debt holders, this can particularly provide me with a bankruptcy risk. Now, one NBFC going for a bankruptcy might disrupt the system. So we need to ensure that the equity tranche or the capital that I have is sufficient to absorb the losses that I bear. With this being said, we should also understand the fact that with the CRAR, there are 2 to 3 issues that ICAAP seems to address. One is that the CRA requirement only covers 3 risks, that is credit risk, market risk, and operational risk. That is itself prescribed under the RBI circular. RBI itself says that the CRA requirement that we have prescribed only covers 3 risks. There are other risks also that are faced by an NBFC that would require capital to absorb losses arising from there that are not covered. So ICAAP would help us assist and provide capital for the risks that are not covered under CRAR. Also, the risks that are covered under CRAR may not be adequately covered. For example, for credit risk, my credit risk profile may be much higher. I take a simple example. For an NBFC, for a HFC, the credit risk might be much lower, and hence the RBI regulation prescription would be sufficient to cover the risk. But for an NBFC into personal loans or a very short-term loans, the default rate might be much, much higher. Hence, there might be a larger risk. To address those larger risks, what we need to do is to provide a capital. And this how do we know that this capital I'm providing is sufficient or not? I do an internal assessment. With that brief in mind, we move ahead to understanding what are the expectations from NBFCs. So when the regulator comes out with this requirement of NBFCs to undertake ICAAP analysis, what is the regulator expecting from us? The regulator expects us to conduct a analysis to determine the capital sufficient. Now, this analysis is to be entity specific. This is a very important point over here, that ICAAP, its entire approach is that it should be entity specific, because a general prescription in way of CRR is already present. The intent here is that you do assessment basis your operations, your complexity operations, your type of assets, the manner of working. Based on that, what risk you face, you assess that and accordingly provide the capital. So the process being entity specific and tailored up to my requirement is very important. Another point is that ICAAP should be a forward-looking process. That is to say that not only would I consider a backward-looking approach, that is, I will consider my past experiences, but I would also look forward what I'm going to do ahead in my business. I would give a simple example. If I am going to start with the riskier class of asset in the further years, I should think about increasing my capital. Why? Because I am going to start with the riskier asset that might cause greater defaults, and I need larger capital to absorb those losses. Another is it's a risk-based process. So ICAAP would assimilate my existing risk processes, act as an umbrella, and help me determine that the capital maintained by me is sufficient. Now, I'm again going on the point of sufficiency of capital. So what I do is I do a risk-based assessment. I will go into a detailed step-by-step approach of how this process works out of the assessment of risk, but it's a risk-based process. That's very clear till now. And another point is ICAAP should also be integral part of decision-making. So when I say it's an integral part of decision-making, what I mean is that ICAAP results should be considered when the senior management or the board is taking its decision. Now, these decisions can be simpler ones like raising of funds, that how my funds would be raised, should it be through equity or through debt, such decisions, or even business decisions. If I'm wanting to go for a certain asset class or start with a new asset class or end up an existing asset class, is my capital sufficient for these operations? Because if I'm wanting to start a riskier class, I should also be able to provide for a larger capital. Am I appropriately equipped to do it or not? ICAAP would also assist in those decision making. So it's not only a process to determine that my capital is sufficient or not. It has to be a part of a decision making itself. So this makes ICAAP a very comprehensive assessment, and hence the framework should be comprehensive enough to cover and provide for all these requirements. Now, as I have been mentioning, that we will discuss what is the broad process of ICAAP. So as I mentioned initially, what ICAAP is, I do an assessment and then prepare an ICAAP document. So how do I do this assessment? What is the approach? How should I look towards the assessment? So the Basel III circular, it prescribes that the NBFC should, and it rather talks about banks, but same would apply to NBFCs as well, that we should bifurcate or classify our operations based on complexities. As I said, this assessment is entity specific. So I would first do an analysis that how complex my operations are. This complexity of operation would help me determine that to what extent or what should be my approach towards ICAAP. So when I'm determining a process, I should first consider how complex my operations are. So there are three classifications over here. One is simple, another is moderately complex, and there is complex. But we should take note that these classifications are prescribed in relation to banks. So if we apply the same guidance for NBFCs, in our view, most of the NBFCs should be under simpler approach, because compared to banks, our operations are simple. And hence, most NBFCs should suffice going for the simple approach. However, there are some NBFCs whose operations are as complex as banks. You all know the names of few large NBFCs whose operations are very much complex. They're nearly banks, or they can even compete with banks. These entities might want to go for moderately complex approach or complex approach, but all other NBFCs having simpler operations like taking funds from the market lending activities, they can go for simple approach. But of course, it's an entity specific analysis. We have to do an analysis. That's a call that the senior management has to take. The senior management decides that we have simpler operations on the basis of some facts. We have to, of course, appropriately capture these facts or the basis on which we did the assessment of our complexity operations. Once we've done the complexity of operations, I'm talking about two approaches here. One is simple and one is moderately complex. Complex, as I said, it's rare situations even for banks, so we are not seeing it for NBFCs anywhere. For simple operation, what we do is we prepare a list of significant risks. Now, here importance comes to significant risk. When I go for a moderately complex operations, the list of risk that I prepare should be for comprehensive list. That is, all the risk faced by me should be covered under. What is a list of risk? Basically, if I'm going for a risk assessment, I would first need to know what all risk I have to assess. So what all risk I have to assess, I prepare a list. The very first approach in the ICAAP is to prepare a list of the risks that I face. Now, what all risks should be covered under that list? If you have a simpler operations, you go for significant risk. If you have a moderately complex operation, you prepare a comprehensive list. That is the foremost difference between simple approach and the moderately complex approach under ICAAP. Once I prepared the list, I divide this list into two parts. One is the risk that would require quantitative assessment, the risk that would require qualitative assessment. So quantitative assessment would, of course, be for the risk like credit risk, liquidity risk, concentration risk. All these kinds of risk which can be quantitatively analyzed would go for quantitative assessment. Risk that cannot be quantitatively analyzed, such as reputational risk, IT risk, we may not be able to provide a quantitative models for it. These kind of risks, we have to do a qualitative analysis. Basis the qualitative analysis, we have to determine how much capital we would require from the risk faced by these items or risk. Once we have done this assessment, what we also need to factor in is that we see a forward-looking approach. So as I mentioned in the previous slide, so when we look forward, what we do is we align these assessments with our business plan. That is to say, what I would do is I would see what my next 3 years would look like, or my next 5 years would look like, what all operations I'm going to do, if I'm going to start a new product, if not, if my existing products are going to grow, if do I have plans to bring in enough capital to provide for it, would my profits be enough or my capital growth be enough to cover the risk faced by the further operations in the next 5. So after factoring those, I prepare a ICAAP document. This is the findings of the ICAAP document. Once the ICAAP document is prepared, it's reviewed by board and submitted. So this is the broad process of how ICAAP should work. Now we delve into each process in detail. So here I discussed that first I prepare a list of risks. There can be two other simple operations only significant here. If it's a moderate complex, we go for comprehensive risk assessment. Then we do a risk assessment. We consider how the capital would look on business plan. We document the findings, and that goes for the board. Now we discuss major steps in detail. So as I talked about, we prepare a list of risk faced by the entity. Now, when we are preparing this list, we need to consider, what do we need to consider? How do we arrive at the list risks that are significant? So I would majorly talk, if I am in the simple approach, what I would see is major losses that I have incurred in the last 3 to 5 years. So I would go assess that in the last 3 to 5 years, what all major losses I have faced. I would see my business plan, what all operations I'm going to do, what all risk I think would factor in, how I'm going to grow. Depending on these all factors, I prepare what all major risk I can face. Once I prepared this list, I already mentioned we will divide it into quantitative or qualitative risk assessment and accordingly develop methodologies for assessment of these. Here, it should also be taken note that senior management, board and RMC have a very important role to play. The board and RMC would, of course, have a guidance role to play, and the senior management should be the one determining that what all are the major risks. Hence, and of course, needless to mention, CRO becomes a very important role. The CRO gets the main responsibility of doing all this. I have also under the presentation mentioned the indicative list that are provided in the RBI Master Circular on Basel III framework. Of course, there can be other risks also. It's just an indicative list. There can be other risks also. There may be some risks that are not relevant for you as well. Another important point here is use of econometric models in stress testing. Now, this is something that we have been facing a lot of queries in respect to that. When we talk about quantitative assessment, what is RBI expecting? What should be the models for it? So I would say it's as simple as assessing how much losses can be incurred from the risk. A risk assessment exercise. So a risk assessment exercise should be inherent in any NBFC's corporate governance framework. It is not something new. I should be doing an assessment that whether the risk I'm facing, I'm adequately capitalized for it or not. So econometric models, I was not expecting a very complicated models or frameworks to come in, but it should be sufficient as per the complexity of operations that you have. So it's, of course, there is no specific model prescribed by okay, you use this model or this particular technique or this particular method to arrive at this. RBI has said that you consider, it's an internal assessment, as I mentioned. So you consider, you take a proper call that how complex your operations should be, is the capital involved or not, or to determine that you particularly use models that should help you out. Another thing is that is present in the ICAAP is stress testing. Now, this term has been causing some issue. So what stress testing means is that I stress up the factors. I would give you a simple example here that when you do a capital adequacy assessment or assessment of the risk, you came out with a result. So say I will overview of the process. I prepared a list of significant risks, saying my operations are simple. Now under that list, one risk was say credit risk. Of course, it would be there for all NBFCs. And I did an assessment of credit risk, that how much expected losses can arrive from that. Now, this is something that I say ki expected losses from credit risk is say 3%, very normal assumption I'm taking. Of course, it's an assumption. So I'm saying 3 to 5% something in between my credit losses should be there. So I need capital to cover, enough capital to cover these losses. Once I have arrived at these losses, there might be chances that the factors or assumptions that I've used under these calculations may not hold true. There might be situations go up and down. And of course, I would say in 99% situations, the figure at which I have arrived would exactly not match the outcome. There would be, of course, there'll be some increase or decrease in it. So to ensure that we are appropriately ready for it, what we do is a stress testing. What is stress testing is that I stress up the factors to check to what extent is my entity resilient to stressing up of the shocks or absorbing of the shocks. So say a COVID-like situation arrives. I had expected a default rate of say 5%, but it turns out my default rate of 20%. Why? Because COVID happened. Now, so to address such situations, we do a stress testing. So once I do the assessment of the risk, then I do stress testing of it. Now, how do I do stress testing? There are two popular approaches: sensitivity analysis and scenario analysis. Basis that, I stress up the factors, arrive at the results, and then I check that to which level my capital is sufficient to meet up these stress factors as well. This is the broad overview of how ICAAP should work. To give you though I've repeated it several times, just a broad overview, how the ICAAP would work. First, I determine the complexity of operations. I prepare a list of risks. I assess the risk, either quantitative approach or qualitative approach. Basis that, I determine how much expected losses are. I stress up those factors considered to arrive at stress testing. After conducting the assessment of risk as well as stress testing, I develop a process to determine how much capital I would be required to cover these expected losses as well as the stress testing results. When I've arrived to it, I summarize it into an ICAAP document. This ICAAP document is submitted to the board for its approval. Once the board approves, I submit to RBI, which may come out with its reviews. That was a short piece on what is ICAAP, what is expected out of you, how the framework should be designed. Of course, there are multiple aspects to it. There are detailed topics on how there is on every step that I took it very briefly. There might be discussions on it, but I think we can follow up into the subsequent videos. Thank you for your time. Thank you.